Strategic Stock Picks for Investors, Harnessing Growth, Income and Innovation. This report evaluates 6 stocks: Apple Inc., Analog Devices Inc., Kinder Morgan, Global Foundries Inc., Intel Corporation and Viking Therapeutics, recommended to savvy investors. The recommendations are based on performance metrics, financial ratios, growth potential and market trends. Each stock is categorized as either a strong buy, cautious buy or speculative buy, offering a diversified approach to long-term value and risk management. Strong buys, recommended to savvy investors. Apple Inc. Strong buy. Why buy? AI integration and innovation. Apple's upcoming AI-focused features like Apple Intelligence are expected to drive iPhone upgrade cycles and generate new demand. The partnership with OpenAI enhances the App Store's growth potential. Financial strength. Apple boasts a market cap of $3.57 trillion, an EPS of $6.57, and strong ROE and ROA metrics of 160.58% and 30.59%, respectively. Growth prospects. Analysts project EPS growth of 10.67% next year, supported by a forward PE of 31.67, reflecting confidence in future earnings. Shareholder value, a dividend yield of 0.42%, combined with consistent share buybacks, provides income and capital appreciation potential. Why not buy? Valuation. Apple's PE ratio of 35.78 makes it relatively expensive, limiting short-term upside for value investors. Debt levels. A debt-equity ratio of 1.52 is on the higher side, though manageable given Apple's strong cash flow. Conclusion. Apple is a strong buy recommended to savvy investors. Its innovation-driven AI features, robust financials, and leadership in the tech sector make it an essential long-term investment. Analog Devices Inc. Strong buy. Why buy? Dividend payout. ADI offers a dividend yield of 1.59%, appealing to income-focused investors with a payout ratio of 50.98%, signaling sustainability. Institutional backing. Strong institutional ownership of 91.44% reflects confidence in the company's long-term prospects. Profitability and efficiency. ADI has a 17.07% profit margin, and while EPS has declined this year, it is expected to recover by 18.20% next year. Operational margins also remain strong, with a gross margin of 49.89%. Solid balance sheet. With a debt-equity ratio of 0.23, ADI maintains low leverage, enhancing its financial stability. Why not buy? Valuation. A PE ratio of 68.60 makes ADI more expensive than its peers, compounded by an EPS decline of 55.02% year-over-year. Performance concerns. The stock's year-to-date increase is just 14.57%, and quarterly sales show a decline, raising some concerns. Conclusion. ADI is a strong buy for savvy investors seeking stable dividends and long-term growth. It is a strong performer in the tech sector with robust institutional backing and solid financials. Buy recommended to savvy investors. 3. Kinder Morgan Inc., KMI. Buy. Why buy? Kinder Morgan is set to benefit from rising power demand driven by AI and cloud computing, with natural gas expected to play a crucial role in powering data centers. Kinder Morgan offers a dividend yield of 4.57%, appealing to income-focused investors. The company's PE ratio of 21.93 and RO of 8.33% indicate stable performance. With consistent year-to-date growth of 41.44%, it provides steady value appreciation. Kinder Morgan's stock has grown 12.87% over the last 50 days, positioning it as a reliable income and growth stock. Why not buy? Kinder Morgan's debt-equity ratio of 1.05 is relatively high, presenting potential risks if interest rates rise or cash flows shrink. Despite its strong dividend, sales growth has been modest at 4.24% over the past 5 years. Conclusion. Kinder Morgan is a buy for savvy investors. Its stable dividend and exposure to the energy boom make it a solid pick for those seeking income and steady growth. Cautious buys recommended to savvy investors. Global Foundries Inc., ticker symbol GFS, is what we call a cautious buy. So why should you consider buying it? First, let's talk about valuation. GFS's price-to-earnings ratio of 27.55 and forward PE of 21.15 signal the potential for future growth. Next, growth potential. GFS is projected to see a 36.88% earnings per share growth next year, positioning it for a rebound. Then, there's sector leadership. As a key player in the semiconductor space, GFS is well positioned to capitalize on growing demand in sectors like AI and 5G and high insider ownership. With 84.52% insider ownership, internal stakeholders have strong confidence in the company's future. Now let's discuss why you might hesitate. Volatility is a big factor. The stock has seen a 33.50% year-to-date decline and a 30.98% decline over the last quarter, highlighting its volatility. Profitability issues are also a concern. Earnings per share have declined 37.85% this year, and revenue dropped by 12.39%, raising concerns about operational efficiency. In conclusion, Global Foundries is a cautious buy for savvy investors looking to capitalize on the semiconductor sector's long-term potential. The stock's volatility makes it better suited for those willing to ride out fluctuations. Intel Corporation, ticker symbol INTC, is a cautious buy. So why should you consider buying Intel? Well, first off, it's undervalued. Intel's stock price of $34.75 is significantly below its 52-week high of $51.28, presenting an upside potential of over 30%. Next, Intel's push into semiconductor fabrication is a strategic move to capture market share from TSMC. This could drive long-term growth in AI, 5G, and autonomous vehicles. Also, Intel's dividend yield of 2.24% and strong cash reserves of $6.85 per share provide a buffer against short-term risks. And Intel's EPS is expected to grow by 306% next year, offering potential for a turnaround. But why might you not want to buy? Well, Intel's stock has fallen 36.02% in the last quarter and 55.60% year-to-date, reflecting weak investor sentiment. Moreover, a PE ratio of 97.17 makes it overvalued compared to peers. Additionally, Intel's operating margin of 0.92% is low, with EPS volatility adding to investor concerns. In conclusion, Intel is a cautious buy for investors looking for undervalued opportunities with long-term potential. Its foundry business and recovery prospects make it appealing, but profitability concerns mean caution is advised. Speculative buy recommended to savvy investors. Viking Therapeutics, ticker symbol VKTX, is a speculative buy. So why buy Viking Therapeutics? Well, they have a promising pipeline. Viking Therapeutics is advancing into phase 3 trials for VK2735, a potential breakthrough in obesity treatment. Early trial results are encouraging, with patients showing 5.3% weight loss. Also, Viking has seen a 253.57% year-to-date gain, driven by investor optimism over its clinical trials. High institutional ownership of 74.36% further supports confidence. And the stock's forward EPS growth of 40% over the next 5 years signals significant upside. However, there are reasons to be cautious. Viking is not yet profitable, with EPS trailing 12 months of 94 cents and no revenue, making it a high-risk speculative play. Additionally, the stock is down 33.81% from its 52-week high, and its beta of 1.00 indicates significant volatility. In conclusion, Viking Therapeutics is a speculative buy for savvy investors. Its promising clinical trials offer substantial upside potential, but the stock's volatility and lack of profitability make it unsuitable for conservative portfolios. Final recommendations. For strong buys, consider Apple, ticker symbol AAPL. It's innovation-driven with solid financials and market leadership. Also, Analog Devices, ticker symbol ADI, a stable dividend payer with strong institutional backing. For a buy, look at Kinder Morgan, ticker symbol KMI. It's a reliable income stock benefiting from AI-driven energy demand. For cautious buys, Global Foundries, ticker symbol GFS, is a key player in the semiconductor space, but prone to volatility. And Intel, ticker symbol INTC, is undervalued with long-term recovery potential, but facing near-term profitability issues. For a speculative buy, Viking Therapeutics, ticker symbol VKTX, is a high-risk, high-reward biotech play with breakthrough potential in obesity treatment. For savvy investors, this diversified portfolio offers a balanced mix of growth, income, and speculative opportunities.